John, I swear I'm not just mining my Rolodex from my alma mater alumni list for podcast guests, but I've had a couple of Elon guests on in the past from my undergrad days, and now you're my first MBA, my first Duke
awesome.
Fellow alumni.
Great.
And I hope the audience knows we're not like just mining alumni here. I'm interviewing across the housing industry, but happens to be a few folks who share my background. So, John, I'm sure you went to Duke for business school with the intention of starting a mortgage technology company, right?
Absolutely. I mean, half my class was there to do that, right? No, it was Duke was a great experience, but spent 2 years there in their daytime program, and really was looking for a career change. Right, I was moving kind of from the investment banking world and wanted to get more into industry and ended up moving into American Express and spent about a decade between American Express and PayPal and in the consumer credit world before having a bad mortgage experience that landed me in this wonderful industry. So
I know we talked about this before, but when you were at Amex, were you in New York or where were you based?
I was in New York for a little bit and then spent most of my time in London. So I was in their international consumer group. Doing everything from business development for a while, business operations, and then I led a $200 million revenue P&L for them out there.
Huge. Well, we didn't know each other at the time, but we were probably like a couple floors away from each other in World Financial Center when I was at RBC, and you were at Amex in the same building.
Yeah. Nice part of New York. Fun memories in New York City.
But now we've moved on. You're in snowy Colorado, and I'm in hot/cold/hot Texas, depending on the day. It moves back and forth.
Something about New York that's not as conducive to families and strollers and all those things, right?
Not so much. But so John, let's jump into talking about your business that you were a co-founder and CEO of Maxwell. And Maxwell, I think, started kind of popping up on the HousingWire radar in 2017, and a year that Maxwell was initially recognized as a Tech 100 winner. And I went back and grabbed the profile from 2017, and I think you've changed a little bit. So like the initial business was proposed as Maxwell is a Silicon Valley-based point-of-sale and workflow automation tool built for loan officers and borrowers. And if I understand correctly, Maxwell Point of Sale is still alive and well, but you've also expanded into a lot of other areas.
That's right. Yeah, we've gone from just being a point of sale to really thinking about the entire origination value chain and how do we use technology and capabilities to serve local lenders to enable their business with better software, better efficiency, and better pricing across the entire stack. I think we realized as we started to serve, really what I would qualify as the longer tail of the market, those doing kind of less than $5 billion a year in originations, they didn't have the capabilities to really, create the kind of efficiencies on their own. And so our ability to do that at scale by combining them together, pulling them together was pretty incredible. It's a lot of like what we did at PayPal and places like Square, right? You use your larger platform to bring benefits for, the smaller players that are part of it.
I think across fintech, there's always a lot of conversations about being end to end versus being like niche, best of breed, and focus. And I think you're bringing up an interesting decision point on like servicing and serving the long tail of the housing market. And we know that mortgage has an especially long tail, but I think the tail for real estate agents and brokers might even be longer. So that's an interesting like industry dynamic, which influences like the players that might choose to go incredibly narrow versus attempt at more of an end-to-end strategy.
Yeah, and I disagree with the premise that doing more things means you're not best in class. And so I think it actually helps us be better in class, right? So for example, our point of sale is better because we also do fulfillment, right? We know what happens to the loan when it hits processing. We know what happens to the loan when it hits underwriting. We do diligence and QC. We know what happens when it hits the secondary market. We trade it. We know what those steps and post-closing looks like, right? And so a lot of those problems are created by the borrower at the point of sale, and we can help solve them early so they don't happen down in the chain. So I actually think we have a better solution as a result of doing all those things.
And so let's go back to the early days and 2015 when you were founded, 2017 when from the timeline when I just read this description of the business, was the Was the vision of being multi-product or multi-service like part of the roadmap from early days, or was there like an evolutionary point where you and your co-founders had the view that there's a bigger play here?
Yeah. So if you go back way back in the Wayback Machine, you look at my angel pitch deck. It was in there, right? The original idea was there. I had no idea what I was talking about back then, but it was in there, right? And so I've certainly evolved in the how, but the what was there, right? And coming out of a business like PayPal, where you have payment networks that are in the transaction with their clients, right? They're creating value. They're not selling software to their clients. They're in the trenches with them, delivering the product. That's what we wanted to create at the end of the day, right? And leverage the scale of the network to bring cost benefits, efficiencies, margin back to our clients. And so, it's a multi-phase vision, and we needed to get scale first, and then start adding capabilities. And now we're in kind of the next inning, which is starting to really standardize how that mortgage is originated and the quality that kind of comes through our funnel.
I think one of the more like interesting launches that we've seen from you in the last few years is Maxwell Capital.
Mm-hmm.
Give us a glimpse into what Maxwell Capital does.
Yeah, so Maxwell Capital, we have this year we'll have about call it $75 billion or so volume flow through our platform. So we're effectively, if you were to put us on a list of lenders, we'd be in the top 10 probably, if not in the top 5 this year. And so we have all the data on all those loans. In many cases, we're directly affecting the quality of those products through our fulfillment and QC. And so why shouldn't we be the ones to purchase them and help trade them in the secondary market? And so being able to do that at scale and deliver better pricing to, a community bank or an IMB that's doing 150 million, 200 million a year, they can't get access to those kind of investors on their own is incredibly valuable for them. And I think the theory over time is, because we know the quality of the product that we're trading, eventually, the pools that we're creating will be more valuable because there'll be more transparency and integrity and quality in those loans.
I know the roadmap from the beginning was multi-product and multi-service, but have there been specific clients that have helped pull you forward into these areas, or long tail client segments that said like, hey, John, hey, Maxwell team, like we need support on the secondary market. Is this an area you can play?
Yeah. I mean, if you look at all of our products, it's all customer driven. I always think the best businesses are built when your customer's kind of pulling your roadmap out of you. That goes all the way back to early days. We spent really the first year before we launched anything with over 1,000 mortgage professionals, just interviewing them. One of my co-founders came out of the Stanford D School, and so had a very big bent on empathy and really understanding user problems. Walking into a mortgage broker's office in Birmingham with a case of Red Bull and saying, "Hey, can we just feed you Red Bull and staple papers for you and watch you work for a week?" And I think he's still a client, pays us like $10 a month or something. Hey, that's great, right? And he helped us effectively, drive our roadmap forward and understand the problem. So every phase of the business has been, certainly driven by clients. And now that we're doing it ourselves, we basically have internal clients, right? We have our own processors, we have our own underwriters, we have our own QC analysts, right? We have our own traders. And so, we call that dog fooding, right? We eat our own dog food. And so when we build software like Processor Edge that we just launched this year, we've been using that tool internally already for a year before we launched it. And so we're just able to get to market a lot faster and a lot sharper.
What had to change in terms of the team and strategy to be prepared to be this kind of multi-business unit operation that you're running today?
Yeah, I think a lot of it had to do, particularly over the last, call it 3 years, as we evolved from just pure software into actually doing a lot of this work, is bringing in people that deeply understand the mortgage industry. And so if you look at our management team today, there's certainly folks like me and my CTO that come out of Silicon Valley and come out of tech, but it's supplemented by folks like Bob, our CFO, right, who was COO and CFO at PHH for many years, led all of the operations at JP Morgan Chase on the mortgage side. Folks like our general counsel, Sunny, who spent a decade at Fannie Mae, right? So we have that expertise, in our management team that balances out the those of us that are a little more techie, and maybe didn't know how to split a mortgage 10 years ago.
You're putting yourself in that category, right?
Sure. I mean, I was fascinated by this industry. It was a multi-trillion-dollar industry that was still being run on Excel. And so I think there was, huge opportunity that attracted me to it, and to be kind of a learner and ask a lot of good questions.
It's interesting the business was founded in 2015 because I'm talking to a lot of folks across the fintech and mortgage and housing tech ecosystem. 2015 was a kind of a pivotal year and a turning point for technology adoption and the beginning of this current innovation wave in the housing ecosystem. Did you face any headwinds out the gate on getting early adoption on point of sale or other products? And how has that changed kind of as the industry has evolved?
You know what I'm most grateful for is Super Bowl January 2016. There was a company called Quicken that had an ad that said push button, get mortgage. And all of a sudden, everybody said, I can't do that. Can you help me? And so that was a huge win in our sales. I remember back in the day when I was still making sales calls, right? We'd call up a lender, and that was the way we explained it, just like push button, get mortgage, but for you. And so grateful to our friends at Quicken and at Rocket for really, setting the stage for the industry and setting a pace of saying, hey, technology needs to be part of the way we do business in this industry. And I think you need pace setters like that are pushing the industry to evolve. So that's been really helpful. And of course, we have great partners at Meridian Link and ICE now, formerly Ellie Mae, and others that have been great partners in moving that technology forward and creating open APIs so we can start to integrate and share data and work together. I think that's just been a revolutionary change really over the last few years, as people are more open to collaborating and sharing and integrating. It's really accelerating adoption and change, which is fantastic.
And you bring up an interesting point about how competitors or folks in the ecosystem that might not be clients, but still like play in the ecosystem, can be partners in market development, and how having multiple players in a market can pave the way toward adoption for everybody and ultimately grow the pie.
Absolutely. And I think any time where there's a new industry and a new product, like point of sale back in 2015 was relatively new, and Roostify and Rajesh and the team there did a lot of that early work of sort of missionary selling, right? They were one of the first brands out there that was talking about improving the borrower experience, right? Blend was still, I think, in stealth through 16, 17 or so, right? And before they started to come out, and some of those early folks did a lot of the groundwork that and Simple Nexus obviously has been around for a while, but they were very sort of niche mobile app focused at the time, and a ton of respect for all the competitors, and all of us are focused on a very similar goal, which is helping the industry evolve technologically to where it needs to be.
If you think of 2015 through 2017 as kind of the early part of the point of sale wave and the early part of point of sale innovation and adoption, can you draw any parallels to waves that might be starting now? Like, what technologies do you see in 2021 and 2022 that are maybe just starting in their impact on the industry, or might not even really be might still be kind of behind the curtain?
Yeah, so I would say two areas. One is, back office, a lot more focus, from our friends at Candor, for example, on underwriting, from us on processing, and beginning to think about where all this manual labor is happening, a lot of administrative work. I think it's Garth that always says the greatest innovation in mortgage was 2 screens, right? Reading one data piece on one screen and transcribing on the other. And so, how do we move the humans from being, effectively data entry to actually doing things humans should do, which is making judgments, right? And making decisions and tying logic together in a way that a computer might not be able to. So I think we're in the early stages of that being really impactful in the mortgage origination process. I think the second area, there's a lot of very early interesting stuff going on, is in the secondary market. Because everything we do in this industry in origination ends up in the secondary market, right? And now you have this huge industry of investment banks that are trading pools and securitizing these pools, and there's a lot of demand for accurate, reliable data. And I think that's a really interesting space to recognize where all of our loans and our data end up, and how do we support that end of the market, ultimately the buyers, in being successful. So I think there's a lot of interesting companies doing things in that space too.
Yeah, that's really interesting. And it seems like innovation had to start at the front end and at point of sale. And now, for better or for worse, with cost in focus, the operations and closing and checking checkers side has to be front and center to build a more efficient mortgage ecosystem. It's tough to watch the MBA IMB costs of origination study and kind of see the cost to originate keep shooting up. I think the most recent report was over $11,000.
Amazing. I mean, my favorite joke is it costs more to originate a loan than it does to build a Toyota, and so
which is insane.
There's something wrong with that. Yeah. So it's gotta evolve and get better. I mean, from where you sit, what are some areas that you hear people being excited about?
Well, I mean, before we move on from the topic of like cost of origination, I think it's like, worth like putting regulation in the spotlight and like knowing how important regulation is, but the direct correlation between cost to originate and timelines of Dodd-Frank, and figuring out a level of regulation that works for the industry and does not end up costing homeowners a lot of money. Ultimately, these costs do get passed through. I'd say is a front and center focus that I think needs to get as much attention as possible across the housing ecosystem.
Yeah, that's right. I mean, Dodd-Frank was 2010, CFPB was created in 2011. And from that came things that needed to happen, right? But they were layered on top of an industry that, that was filling the holes with human spackle and needed to figure out other ways to resolve those problems beyond just fingers and bodies.
Yeah. So to answer your question on what I'm seeing, so I think you're spot on the focus on operations like that. Like there's a lot of room for innovation there, and that's an area that's going to get front and center focus until lenders find profitability. So really important area. The other important area that I think is in response to an issue in the market is the issue being affordability, and the innovation being product innovation. And one of the things we've seen over, it's a whole thesis behind HousingWire, right, of covering the whole housing industry, is that real estate and mortgage keep getting closer together, and real estate brokerages, loan origination, loan servicing, and capital markets need to communicate and digest the same information and move in unison to build a more sustainable and efficient housing economy. Like that's our thesis, and like where we see that playing out right now is innovation on like the home purchase and finance process. And I think there's a lot of interesting stuff happening with power buyers and like cash buyer kind of alternatives. And I'm also really interested in what's happening in the shared equity space. And like, I don't know if that's necessarily going to be a great thing for consumers or for the housing market, but in the moment we are in right now, it's an interesting place to watch as they attempt to address challenges with affordability. And I think everyone's got a different view on the housing economy, and how much pain the Fed is willing to inflict and how it will impact home prices. But if you subscribe to the gospel according to Logan Motoshami, I don't think we're going to see our affordability challenges solved by home prices coming down anytime soon.
Yeah, conforming limits are up above 1 million, right? So, I think you're totally right. That I'm a big fan of credit. Credit is one of the greatest inventions of all time, right? It was essentially the foundation of the Industrial Revolution, right? The ability to take in a lot of capital that you can't have your own on an interest rate and invest it. And just like, you and I, and others being able to buy a home with a 30-year loan at a fixed rate. I mean, that's amazing. Right. And so, but those products also haven't evolved much. And I think there's a lot of great innovation happening there right now. And part of the thesis behind our business is, with the scale of distribution we have now across these hundreds and hundreds of banks and institutions that originate loans, we can distribute those products, right? And we can make those available to more homeowners. We're lowering the cost, we're increasing margin, but more importantly, can we create products through Maxwell Capital that give people access to data? One example for you, we looked at over the last 6 months, 50,000 loan declines. And we said, let's take a look at that data set of 50,000 loan declines, and could we create a product, and can we find segments of this 50,000 population that are actually great credit risks, right? Like we would totally give them a loan. And we found about 15% of that base is sort of a no-brainer. Like we could go to partners on Wall Street and create a product that would be fantastic to give access.
Like if they had walked into like an old school community bank, they would have gotten a, like one of those like portfolio loans that like a no-brainer kind of underwriting.
Exactly. They just didn't fit the Fannie Freddie box or whatever it was that particular lender was trying to fit them into. And there wasn't a bunch of creativity to figure out other places we can put them. So the great news is I think a lot of those products are out there. They're just not finding their ways to the consumer. And we want to help solve that problem through these institutions, to your point, that know their borrowers. I was talking to a customer, community bank. They probably have about 8 branches. And I was talking to the president, and he said, we don't even have underwriters. I said, you don't have underwriters? He's like, no, the loan officers do the underwriting. The loan officers do the underwriting. I said, your loan officers do the underwriting? He's like, sure. They've been, employees of the bank for 20, 30 years. They know the family. They know their father. They know their grandparents. They coach their soccer teams. They go to church with them. They just know them so well. Who else would I want doing the underwriting? And so, is there a way to sort of imitate that with data at scale where you can get to know the credit risk much more intimately than a 3-digit number to make a decision?
All right. So this is like 50,000 like loan evaluation. Was this done under the Maxwell private label origination business line?
So this was done across all of our products. So we looked at loans across all of the products where we get to touch that data. And really to ask the question, is there a space in here for us to work with our partners to create products that broaden that pathway to homeownership for more people?
Yeah. So we're also seeing a lot of interest in not just product innovation on like shared equity or power buyers, but product innovation inside of like, relatively traditional mortgage products, just non-conforming. So like the non-QM product set, a ton of interest in the in reverse mortgages that we're not seeing that in the data yet of reverse volume picking up. I mean, we've made our bets there and acquired a couple small reverse mortgage publications and put in a lot of effort into bolstering our non-QM audience from a origination perspective. How do you see kind of lender interest from like the folks that you have strong like point of sale or fulfillment or diligence relationships with, and their interest in private label, non-QM, reverse, kind of the non-conforming set?
Yeah, I mean, I think obviously today there's a lot of hunger for it, right? Because you want to be able to say yes to as many people that walk in your door as possible. The traditional lender has the challenge of education. How do I educate my sales force so that they're able to converse and sell and talk about these products to their customers and the breadth of products that we could offer as a lender? I think to some extent, again, us as a point of sale and also a correspondent, is that we get to also have the eyeballs of the loan officer and the consumer through that conversation. And so, eventually our ability to put the right products in front of the right people, and we still believe very much in the loan officer and the role that they play, but that in the moment education, if you will, that hyper relevant products when Clayton and his family walk in the door for a loan is incredibly important. So I think that's where we want to evolve to. Is again, we have this huge distribution network of partners of thousands of loan officers on our platform, allowing them to offer those products to their clients in the moment that are hyper relevant and give them access is incredibly valuable.
So John, as we look back over like the last 7 years or so, like you've navigated and operated through a few very distinct environments in the mortgage industry. And we saw the big margin compression year in 2019 that had the industry pretty fearful. We went straight into 2020 with COVID and another wave of fear, and then interest rates coming down, and then bandwidth issues, and like just the craziness that we've had over the last 4 years, like the ups and downs. How have industry market cycles influenced your conviction in the business or willingness to launch new business lines or timing of roadmap? Like how have these cycles influenced like when you're ready to press the gas or when you need to operate with more caution?
Yeah, I've come to love it because I think the cycles create opportunity. With I'm gonna massacre a quote from our friend Warren Buffett here, but something to the effect of wealth is created in the downturns and collected in the upturns, right? And so because you have this industry that's naturally cyclical and naturally seasonal, right? There's always going to be these waves of opportunities that come along, and I think we're in one now, candidly, in that respect. And the other benefit of these waves is it drives transformation, right? And so you see at these different stages this shift in demand driven by the need that cycle brings. And I still remember the April board meeting in 2020. We presented a plan where like 50% of our customers are going to go out of business, right? If you remember, the liquidity crisis was sort of in full heat at that point. That was a scary moment for the industry, and of course we all know how that turned out as 2020 rolled along for the lenders. So I've come to really appreciate it, and what I tell every investor in our first couple conversations as we're talking about investing in Maxwell is hey, this is cyclical, and you have to be comfortable with that, and let me show you how that affects our numbers. And I love it personally, and here's why. And it's not for everybody, right? But I think the folks that understand that and lean into it, I think they ultimately win over time.
Man, I wish you and I had talked about that, like cyclicality and like investor conversation like years ago. Cause I think that's something that took me a little longer to learn, and like not hiding from the fact that the housing market and the real estate industry like does move in cycles, and like the most effective investors and operators will be aligned in the vision that like these businesses will move in cycles. And I think your Buffett quote is beautiful. That's actually one I didn't know that quote. That's a good one.
It might be a Munger quote. Maybe one of the two, but it's a good one to remember. And I think and again, I learned that from our customers, right? You look at the battle hardened CEOs of these companies that have been through these ups and downs. They know it, they expect it, they know how to manage through it. And they know there's thin days and fat days, and you plan accordingly.
Yeah. So I talked to our mutual friend and industry expert, Nima Wedlake, a few episodes ago. And we talked about the topic in investing in these like prop tech and fintech related businesses where the model is moving away from being pure software, which I think Maxwell fits into this category of raising operating capital for the business, but then also having like balance sheet capital, whether you're lending or operating a secondary markets desk or a private label origination business. How did you like come to tackle like that decision of like building a balance sheet that you can run this like diversified business model off of in terms of raising capital?
Yeah, so I don't think our intent is ever to have a balance sheet business where we're servicing a book or doing anything like that. So we are involved in the trading of the business, but we don't hold loans for long periods of time. Typically when we're buying, we've already sold. Eventually we may start pooling, but that'll be again hopefully on a short term basis. So I think we may also evolve to other models where we have partners that are interested in being more of the balance sheet, and again we're providing the flow and the service. So I think that'll evolve. I don't know. My view's still out on that, whether that's something that we want to do longer term or not. Because to your point, it's a different business and a different level of risk, and different people have different appetites for that.
Yeah, absolutely. Yeah, that makes sense. And I guess I understood you weren't building a balance sheet business, but there's still some like a little different capital structure that's needed to even like hold loans for a very short amount of time, right? Versus like the software model.
Yep. Yeah. I mean, we certainly do have a balance sheet that we maintain and manage, and that's a different kind of capital than the growth capital that we traditionally raise. That's right.
Yeah. So coming back to the topic of cycles, I mean, you mentioned that like you believe we might be at one of the points right now where there's opportunity. How do you think about that opportunity for your business? Are you, is this product expansion time or new logo time? Like, how do you where do you focus your efforts on being a grower through a cycle?
Yeah, I mean, part of that I'll have to say you'll see. Um, but I think there's a lot of opportunity. What I'll say is the product mix has shifted, and maybe that's the captain of the obvious statement, right? Whereas in 2020 and 2022, people just needed help. They needed capacity, right? And so we were there to help provide capacity. Now the challenge is not capacity; it's we need efficiency and margin, right? And so we've seen a product shift mix towards more of our products that lean into this productivity efficiency area. And so I think that's where you're going to continue to see us invest. I think the other big problem that customers have is how do I get more potential borrowers, and how do I help them convert? And that's again something that we can help with at scale. So I can't say much about what's coming, but you'll be the first to know.
Okay, nice. I mean, that the topic of finding more business is front and center right now, and I think we've talked to players on this podcast about leveraging servicing portfolios and different partnerships to uncover opportunities. So it's definitely seems to be a front and center focus out there. Yeah,
partnerships are huge, and again, I think in a time where the industry is going through this cycle, we're seeing a lot more people sort of turn to each other and say, how can we help one another? And I think that's great. That's what this industry needs. We're not, even if we might be competitors on the surface, we all want the same thing at an industry level. Let's help each other get there. So a lot of partnership stuff in the works for us, and I'm sure many others.
So if you're talking to peer fintech or peer mortgage technology operators, what do you think are some of the the shared secrets on being a winner through a cycle versus being someone who is gets chewed up as clients look for cost reductions or whatever reasons are that someone loses market share in this cycle? Where do you put your focus to ensure that you're a winner as we navigate?
Yeah, I mean, I think it's for us, it's very much betting on the winners, right? Whether that's betting on the right salespeople that are going to close the deals, whether that's betting on your products that will close and shifting a lot of focus to that. I think there's a lot of cost discipline necessity, right? And managing your costs and being very careful with cash as you manage through the cycle, not being afraid to invest, but you're probably not going to be doing 15 moonshot things, right? In the next 12 months as you move through this cycle. So being very cautious about where you're betting and where you're seeing those returns. I think partnering is important, as we talked about, to see that upside there. And so those are some of the areas that I hear a lot of people talking about in the market. What are some of the ones you're seeing, Clayton?
That the point of not as many moonshots resonates. One of my investors just hosted a webinar this afternoon with Mitch Rails, who's the co-founder and CEO of Danaher. And Danaher has been just a massive success story of wealth creation over several decades. And, they've proven to be one of the best capital allocators out there. And in terms of knowing when to deploy capital into acquisitions and knowing when to deploy into innovation and knowing when to leverage debt and when to issue equity and when to buy back shares. And the capital allocation cycle has flowed with Danaher. But the big one of the big points that Mitch was making to the operators and entrepreneurs on this small call was that your little your test projects, your moonshots that are kind of sucking cash flow, those might go to the wayside right now, and more capital might flow closer to revenue. So if it's if you're having success in a product, maybe move a little bit of budget away from the moonshot and push that into either incentivizing account executives or hiring more salespeople, or going a little bit harder on the marketing lever. So he brought up that kind of similar point that this might not be the market to test organic moonshots, but reserving cash to invest in things that are already driving growth and being successful, or reserving cash and balance sheet capacity for M&A is another area he focused a lot on. And
Yeah, no, our product team is focused a lot, and to that point, on doing things in scrappy ways, right? Because we're not going to deploy 3 product managers and 2 engineering pods to some moonshot. But if a product manager wants to spend 15% of the time trying something out that could turn into something bigger, we're all for it, right? Go for it. And so that's you don't want to lose innovation in the midst of sort of constraint.
I think these cycles can also be career defining, not just for executives, but also for like the product manager that you just mentioned, that's going to spend 15% of her time on a separate product that on the other side of a cycle might be a whole business line, which we're confident she'd be running. And that is that's something that I, watch for closely as we navigate cycles, or like who are like the team members and partners that can put on the battle gear, navigate a tough environment, and innovate and grow through it. And so I think it's it can be pretty defining professionally for the people who know how to play in this type of environment.
Yeah, that's a great point, Clayton. And one of the things I've tried to do as a CEO is, take a look at the folks on your team that can drive results, and they've maybe been driving results in a particular function for a while, and say, hey, tap you on the shoulder. I want you over here now, right? And this is something new and exciting, and I trust you and your ability to execute. And it's a great career development area for them. And again, you're betting on folks that are going to do something well. Maybe they've got the machine operating already over here, and you don't need them on the steering wheel over there anymore, right? But they'll have 10x the results somewhere else. And so I think as leaders, it's also an opportunity to, if you're closer to the floor, your failure is not going to hurt so much through a down cycle, right? And so let's experiment with talent too. It's a great time to do that.
And it's the time, like, people learn a lot about themselves in cycles. And I apply this to the lenders that listen and read HousingWire, that like you're seeing the guys who said, hey, I'm a refi guy, I don't know how to operate in a purchase market. That kind of self-definition is detrimental. And like, I don't think you start to see how dynamic somebody is until a market shifts. And like, we'll bring in another Warren Buffett quote, is you don't know who's swimming naked until the tide goes out. Yeah. And like, this is one of those markets you get to see like who's got what they say they do.
Yeah, exactly. Yeah. And it should breed innovation from the best people to figure out like genuinely hard problems now, right?
So John, as we look forward to 2023, I think a lot of the industry forecasts are, still looking at a pretty tough rate environment and pretty tough margin or volume environment in the first half of the year. How do you kind of prepare your organization and team for different market environments? Like, are you talking to your team about like forecasts you're reading from Fannie and Freddie and the NBA? Like, how do you get them comfortable with like, hey, this is the environment we're marching into?
Yeah, probably like a lot of others, we benchmark our forecasts to our own business forecasts to market volumes, and so we can have sensitivities to say if next year is going to be a $1.5 trillion market, what does that do to our operating results? If it's going to be a $2.2 trillion market, what does that do to our operating results? And so that's an important place to start, and just understand how that market volume affects your customers and ultimately affects you and your different businesses. But we spend a lot of time preparing, I think, in this environment for the downside. What I told our board at our last board meeting is the plan we're putting forward is the downside plan, right? We know that. Right. I don't say we know it, but we have more confidence that, that there's a floor. We know there's going to be upside, but I don't know if it's going to be in February. I don't know if it's going to be in July. I don't know if it's going to be in October. And I don't want to be caught with the tide out with no clothes on if it ends up not being in the month that we predict it. And so
you also don't want to be caught in a scenario where you're not prepared to grow when the market presents itself.
That's right. And if you look at, one of my favorite graphs is, existing home sales since the 1960s overlaid with recessions. And what you see is 2 quarters before recession starts, existing home sales start to decline. So typically housing leads into a recession. And then 2 quarters before the recession ends, you typically start to see home sales coming out of the recession. And so, we lead in, we're in one now. Many people say housing recession. Hopefully we lead out, right? And so if there is an actual economic recession next year, housing will be one of the first to emerge. And to your point, we want to build our fleet and get ready for that moment.
Yeah, I mean, it sounds like we're sharing like pretty similar thought patterns on how we work with our finance teams and think about industry trends. I mean, we're doing the same thing, like building for the downside case and knowing where the floor is, but also planning to exit any type of recession 2 quarters before the broader economy.
Yeah.
And,
you must have gone to good business school, Clayton.
Yeah, maybe. So, all right, John. So you talk about business planning from the perspective of like your business performance rides origination volume. But like I went back and looked at your 2021 Tech 100 nomination, and this is probably a rough number, but like last year you did approximately 70 billion in mortgage origination volume, or facilitated 70 billion in origination volume. So this year you'll do 75. So like you're beating the market. Like the market had a down year, and you still found growth.
Yeah. So the theme that we have in the business right now is durable growth, is the buzzword we're using. And my mantra with the team very much is finding the fast moving water, right? So if you can imagine you're in a kayak and you're headed down the river. The rapids have been moving fast for the last couple of years, but now you're in that lull where the water kind of gently goes around the bend and things have slowed down a little bit, but there's still going to be fast moving water, right? And so our goal and our role right now as a leadership team and as employees at our company, where's the fast moving water right now in the business, and let's find that fast moving water this year. And I think we've been successful at that. And so, our volumes are up probably about 20% year over year in the last quarter, where many others are reporting 50, 60, 90% declines. And so, yeah, just grateful that we're able to help our customers win, and more customers are seeing the value of what we're building, that they can come join what we're doing.
Well, John, it's been pretty fun to learn more about the evolution of your business since founding in 2015 and first Tech 100 award in 2017, and how the business has just grown and evolved and stayed true to that mission of serving clients and helping them win. Thank you so much for sharing a kind of a look behind the curtain at the challenges and the opportunities you face as an operator in the mortgage tech world.
Yeah, thank you, Clayton. Great to hang out.